So now first we will be talking about the market overview. We know that there have been primarily three main developments that have happened. The first development is obviously the Indian Nifty had been at the all-time high, and it had not taken a breather for quite a while, and therefore it was a very prudent opportunity for FIIs and DIIs to book the profit and exit. And obviously the fall is not of 20 to 30%, so as you to be fearful about whether it will fall into the bear market cycle or not. So that is absolutely not the case. So therefore, whatever the investments had gone into the markets over the last quarter, the profit made had to be made. So therefore, the FIIs have taken the money out and they are booking the profit. So that is the main one reason for that. And why it is more so, because the second reason being the Fed rate has not been lowered. And if we talk about the Boston Fed head, Miss Susan, and she has already told that for this year 2024 they are now only looking at two possible times for the rate cut. So that means where previously it was from 2 to 4 times they were expecting the rate cut to be done, that has not been done because the inflation target that they had kept was around 2% for the United States of America. However, that inflation target had not been reached and they are very conservative on it. So they are willing to wait and to see if the inflation tapers down. That was another main reason. And primarily, obviously, if that rate of interest doesn't come down, so it makes US dollar much stronger because the money flows into US dollar because of the strength of currency by its own merit. And not only that, but also the interest rates that are high there. So FIIs will not be bullish in more or less other markets unless and until opportunity cost is not way above what they otherwise would be getting in the US. So that has been one of the main premium factors for that matter. And this obviously will push Indian government not to cut the rates in India, because obviously being done that, the flow of money will not happen. While we are looking at attracting money into the equity markets, we will see a huge outflow of the money from the bond markets, and Indian government cannot risk that. So therefore, unless the US doesn't get it down, many of the companies which are dependent on raising funds overseas will be at the disadvantage, where the companies which are in the pharma sector or the IT sector will still be better, but IT sector has its own other issues to deal with rather than rate not being cut. So that will not do much benefit to IT per se, but yes, pharma can stand to gain benefit if the rate cut doesn't happen. So this is the one element. Then there comes the electoral volatility. We had seen that the state elections of Rajasthan and MP had been very great surprise and positive surprise, and on the face of it, it was very positive outlook that Indian government would be made by the current incumbent government. Having said that, the voter turnout at this time is not that exuberant as was expecting. So therefore, there might be certain risk or being at the borderline, but therefore that has not only given an, you can say, a concern for the investors, but also an opportunity for FIIs or other institutions to obviously not be into the market or to book the profits from the market and take this as an opportunity to get the returns into the cash or other alternative markets. So these are the three views